With the election and the November Fed meeting now behind us, what's still uncertain is the path forward. As we've witnessed, inflation has been receding and the job market is the best in 20 years. So will the economy remain strong under the new administration, and what might the yield curve look like going forward? We're going to get to all that and more right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Leslie Falconio is back here in the studio with me from the Chief Investment Office. Leslie, always good to have you, and this is really a very good time to have you. As I mentioned, we just had the Fed meeting recently. We know now that Donald Trump will be in the White House come January, so we can sort of start to look forward without a lot of uncertainty, although there's still uncertainty out there, as there always is, right? So let me ask you, it's kind of a two-part question, and let me start with the first part, which is now that we know what the incoming administration looks like, at least a sense of some of the policies from Trump and his cabinet, does it bring concerns to the fixed income markets?
Well, listen, I think the concern within the fixed income market was a bit predetermined during what the market was saying with the betting markets, right? And
right.
They were assuming that Trump was going to win, but we had always been calling, if in fact it was a Trump victory, we'd have what was called a bear steepener. And a bear steepener is interest rates rise led by the back end moving higher. And the back end moves higher because the market is concerned of inflation. The back end moves higher because the market is concerned of a rising deficit and supply going forward.
Right. Yeah, because you're looking at something like 6-month and 1-year treasuries, and they're significantly higher when you go further out on the yield curve to the 5s, 10s, 20s, 30s.
That's absolutely right. And I think that one of the things that we were expecting was a steepener in either direction. Mm-hmm. Either it's going to be a steepener where yields come down, led by the front end coming down.
That's right.
Or a steepener where yields go up, led by the back end going up. And in a red sweep, given that, deficit, inflationary expectation tilt, that back end went up.
Right. And as we're sitting here, you and I right now, the House is still yet undetermined, although we know the Senate will be Republican controlled. So there's two at least avenues that we can count on. But going then to the Fed. So now we just had a Fed meeting. The Fed did take another 25 basis points off of the lending rate. Do you think the Fed, given the fact that we know that Trump is very interested in putting tariffs on China and other countries, and they can be inflationary, does it potentially change the path that the Fed is on?
It doesn't. And let me just say this
first.
Not. It does not.
Okay.
And one of the things that the market did when the betting markets were assuming that it would be Trump is that we saw what we call inflation expectations, mm-hmm. which are in the TIPS market. These short-end inflation expectations rose about 150 basis points in, say, 2 months, about 80 basis points since the end of October, as sort of those betting markets started to gain a little momentum, right? But when we think about what you just mentioned in terms of that Fed meeting, is that one of the things that Chair Powell said is that we don't assume, we don't speculate, so they need to see the data. Mm-hmm. And the difference between the tariffs, and again, we don't know what the implementation is going to be, we don't know the duration, we really don't know. We know who the president is, but that's pretty much about it right now. So the one thing about that in terms of tariffs is the Fed has a tendency to look through that, and it's very similar to what we saw, if you think during that COVID time frame when we had transitory and the Fed was hiking to try and bring inflation down, but hiking interest rates wouldn't open a port, right, during that COVID time. The supply side, it won't change the supply side. The same goes for the tariff side. Mm-hmm. Pausing or not cutting won't change, the taxation on tariffs and really what the inflation might be. But they look at this as really a one-time kind of scenario and not the type of inflation that you would see from fiscal stimulus. So in our opinion, they're going to look through it. Okay. And they're going to look at the data. And I think he made that clear that they're going to be data dependent. And remember, it takes time, even if on January 20th, day 1 or 21st, they start implementing some of these tariff situations, it takes time to get in the data. It takes time to get in the economy. And
you said it earlier, that how the Fed looks through tariffs. In this example, that's perfectly stated. So we may not have to worry too much about their direction, the direction of monetary policy, according to what we may or may not see out of the Trump administration when it comes to those tariffs. So thank you for that explanation.
Right. And I think, too, I just want to say, I think the inflation part is, but don't forget as well, tariffs also slow growth. So you can have a combination of slowing growth from tariffs and possibly increasing growth from fiscal stimulus. Mm-hmm. And they just need to look at the balance of the two, but only the data will really tell.
Right, okay, great. So that's something obviously we'll have to look forward down a few months to see. So, something about also that, we hear a lot about these bond bond vigilantes, and essentially they're the traders who kind of threaten to sell or actually sell to kind of move rates to where they want them to be, almost a protest to monetary policy or the direction that things are going. But now, we're seeing the 10-year sitting somewhere around 4.5, 4.6. Depending on what happens with the bond vigilantes and the way the Fed goes, are we looking at a 10-year that's going to go back up above 5%, which we saw in October of 2023 at this point? What do you think we're going here?
I'm asked that question a lot in terms of whether or not we could see the 10-year yield go back to that 5% in 2025. And frankly, sure, we can. I doubt very highly it would go over the 5% because then, the fixed income market doesn't like new territory. And we just saw, as you pointed out, the 5% in October 2023. This year's high is 475.
That's right.
So it's not that far. To go above that 5%, I really think you're getting a little bit of weak knees in both the equity and the fixed income market. But, first of all, our view is still that, listen, you're going to have a choppy, unfortunately, still choppy trading environment because we don't know what the policies are going to be. We don't know what the implementation is going to be. And while, we take Trump seriously, you don't necessarily take him literally. So there's a difference between what he's saying and what he actually might do. And the bond market, which is forward-looking, likes to speculate. So one of the things that we were doing, and one of the things we may do, is to buy on these dips, meaning as yields rise, we really like capturing that income.
Yeah.
We really like capturing that compounding income because we do believe that the Fed is going to cut. More importantly, we think the Fed is going to cut more than the 60 basis points that the market has priced in for 2025. We think it's 100.
Okay.
Right? So that's why we like buying on that dip.
Right, so we're remaining at that. We haven't changed our call yet on the Fed.
That's right.
Okay, great. What about investment grade side of the fixed income family? Because we're looking at the tightest levels that we've seen in like 2 decades, but we still have an attractive call on IG. Why do we still have an attractive on it, and where do you see them going forward from here?
We do, and you're right. Listen, these levels we haven't seen since 1998.
Yeah, they're tight.
Right? They're tight. But why are they tight?
Yeah.
They're tight because even though supply has been strong, we've had a very large technical demand from foreign buyers, from insurance companies that are seeing increase in annuities. So these yields, while spreads are tight, yields are actually on the attractive side given what we've seen over the past 10 years. And that is really the driver of your total return. Not necessarily what spreads are going to do, what yields are going to do. So while we watch the investment grade side, and you're right, we still have an attractive on it, the return from investment grade, in our opinion, is going to come from that carry and a little bit of price appreciation as yields decline a little. Not a lot, but a little bit. But because you're in that higher quality and we have strong corporate balance sheets, we think that really is a place you should be.
Right. Given also now that we've got, we see the belly of the curve kind of a little bit lower now. Now you and I have been sitting here for 2 years up until 2 months ago where we had the yield curve inverted where 2s were higher than 10s. Now we're back to normalcy, at least for now. Given all of that and what you just talked about with IGs, if you think about the next 6 months to a year for investors, where are the opportunities for them now and into maybe the new year, given what because again, as I said, there's a lot that's speculative. We don't know what's going to happen on day one of a Trump administration, although he's been signaling. But given what we sort of know, where do you recommend investors sit within fixed income now?
Well, we've been actually, we've been guiding investors away from the back end of the yield curve, right? That's like the 8+ area all the way out. Simply because our view was the yield curve was steepened, and we just didn't feel that there was good risk reward there. That's still our view, right? So we like the intermediate part of the curve, the 4.5, 5-year. You can get incredible carry, compounding income without taking on a lot of interest rate risk. And we think that that's where you should be, particularly, Anthony, for the things you just mentioned.
Right.
There's a lot of unknowns still. And because of those unknowns, you're still going to have a fairly volatile, treasury market. If we should get to levels such as 475, back to that April level, then I would probably start scaling a little bit further out. But we like taking on interest rate risk. We just want to do it around up to that 5-year area. We also still like the high quality, as we mentioned, like IG corporates, agency MBS. Those have really been the cheap. Agency MBS has been the cheaper side of the sector.
Excellent. Yeah, and you just put out a note actually talking about 5-year treasuries, moving that to attractive, given the correlation between 5 years historically and the Fed funds rate. it's a good spot to be right now.
Absolutely.
Yeah. Leslie, thank you so much. Always great to have you. Good to see you.
Thank you.
Great, and thank you for joining us. Lots more information from Leslie and the entire Chief Investment Office, including that note I just mentioned where Leslie is writing moving 5-year treasuries to attractive, which you may want to be taking a look at and also talking to your financial advisor about. You can find more information on our website, ubs.com/views. Plus, you can follow UBS on all the social media platforms. Also, check us out on Instagram at UBS Trending, so follow us there. And again, if you have any questions about what Leslie and I spoke about today, make sure you're talking to your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everybody.